Welcome to C2 Biz Growth Iron Sharpens Iron podcast, where CEOs and entrepreneurs share how they are overcoming business growth and sustainability challenges.
Hi, I'm your host, John Hale III, and we are excited to have Michael Downing as our honored guest today. Currently, Michael is the CEO and managing partner of MDSV Capital, a venture capital fund established in 2012 that invests in emerging manager funds and directly into innovative companies. Throughout his career, Michael's accomplishments include co-investing in 5 software companies and investing in over 65 early-stage tech startups. As an entrepreneur and operator, 3 of Michael's companies were purchased and 1 went public in 2006. Welcome, Michael, to the podcast today.
Thanks, John. Glad to be here.
Yeah, we're glad you're here. Our first question we want to start off with is how you're showing up today. We know that you're a successful CEO and managing partner. However, from what experiences from your childhood, family, or the earlier part when you started your businesses had a major impact on how you're showing up today?
Yeah, well, I spent most of my career starting and building software companies here in Silicon Valley.
Okay.
And I got there, kind of a roundabout way. I joke with people here that, growing up, I spent more time on the back of a horse than in front of a computer, but it's actually true. I grew up in Texas. A lot of my family are cattle ranchers in Texas. I actually went to university in California, University of California, Davis, and ended up starting a little software company there my sophomore year in school, mostly out of necessity. It's a big university, lots of students, and, needed to get a job and generate some income. I had a couple of buddies who were computer engineers. I took some computer science courses, but I was terrible at programming. And so we got together, created a little company, and like magic, we're able to pay our way through school for the next, 2 or 3 years, which was pretty amazing. So that led me, this is 1994, 1995, led me to Silicon Valley. It was good timing, and ended up starting a series of companies over time in the digital media space. And really spent a good 26 years or so starting and building software companies. And throughout that time period, angel invested in early stage companies, as many people do out here. Started an accelerator for startups back in 2008 called Kick Labs. That was like a co-working space that welcomed in innovative startups, and we would help those startups and assist them and write small checks into those companies. And then later in my career, the last 4 years have really been focused on full-time venture investing and investing in companies, but also focusing in on small emerging manager funds as well. And that's what takes my time today.
Great. Thanks very much for sharing that. And when you describe MDSV Capital, what is the rationale for mentoring and investing in emerging fund managers?
Yes. I think a lot of your listeners are familiar with Silicon Valley and the big innovation cycles we've gone through. We went through a big one in the 1990s where it was just the kind of emergence of the internet. We went through another one in the mid 2000s, 2008 to 2015, where it was the growth of mobile and cloud computing and so on. And now we're in the middle of yet another big innovation super cycle that's being led by AI and deep tech. That's fundamentally transforming business and how we do things. And so, our focus here at MDSV is in a couple of areas. Number one, venture capital has gone through a lot of changes. It went through changes in each of those big shifts that we mentioned in the 90s and the mid 2000s. But one of the big changes that's happening right now is what has been historically a kind of singular simple kind of market, which is venture capital. You invest in companies and you hope that they grow and sell or IPO, has really kind of bifurcated into 2 markets. You now have these venture capital funds who have been around for 20 years, 15 years, who have grown to multi-billion-dollar platforms. And the typical fund size for those groups might be $5 billion, $6 billion, $8 billion. So very, very large funds. And then you have the other side of the market, which we call the emerging manager funds. These are the sub $100 million venture capital funds that are really, in a differentiated way, investing at the earliest possible time period in a company's life, usually at the very beginning, the seed stage when a company's first starting. And those smaller emerging manager funds are different. The managers actually roll up their sleeves and they help entrepreneurs. They get involved at that earliest stage where things are non-obvious, high risk, of course. But it's really the most kind of hands-on and entrepreneurial part of the venture capital investing stack. And so we have experience going back to 2009, 2010, when these small emerging manager funds first started to come into market. And you would see people creating a $2 million fund and going around writing 100K checks into companies. And myself and my partners were involved early on investing in some of those small micro funds back in that period. And we saw firsthand just how the performance of those small funds was exceptional. And we also saw the kind of second order benefit of being able to see which companies were growing from those earliest seed stages to be really significant large enterprises.
Mhm.
And so at MDSV, we've continued to focus from a fund perspective on those small emerging manager funds and being able to track the companies that they back and be able to not only see which companies are most successful, but get the benefit of co-investing in just the most successful portfolio companies that come
Right.
out of that market. And we look at companies that are in AI, of course, which is everything now. We look at
Mhm.
companies that are in deep tech, so robotics and material science, space tech, which is a huge category right now. There's also new kind of emerging categories like defense tech, which has become an important one. And then, of course, all the enterprise B2B and more kind of mainstream business application type space. And so
Okay.
we look across those different areas. We look at those companies, we invest in those companies, and we also back some of the best managers that are out.
Right. Right. Thank you for that overview. That was very valuable. And just for our audience, can you help us understand the difference between uh, private equity and venture capital, just so our audience understands the difference?
Yeah, well, private equity is kind of the main umbrella is,
Hmm.
private investments, non-public companies. You're investing in private companies. You have PE groups who might be doing buyout or leverage buyout or, different transactions like that. That's a specific part of private equity,
Okay.
right? They're going in, they're finding companies, they think they can infuse it with capital and fix up the company or add more people or whatever it may be. That's kind of a unique category unto its own. Venture capital is its own category under private equity, where it's really about investing in new businesses at the startup stage. And so somebody has an idea, somebody has a concept, they think they can build a better solution to a problem that's shared by
Hmm.
many people out there. And, in venture capital, you're providing that risk capital to back those founders with the hope that they're going to build a successful company. And ultimately, you're going to get your capital returned through an acquisition of that company or an IPO if the company goes public.
Right. Right. Okay. Thank you for sharing that. And moving back to the venture capital space and marketplace, can you elaborate on the structural changes in the VC marketplace being led by some of the micro funds and emerging funds?
Yeah, as I was describing earlier, the market's going from kind of a, simple monolithic kind of structure to one that's a little more bifurcated, where you have these large industrial grade multi-billion dollar funds.
Hmm.
They're trying to invest multi-stage. They're now getting into actually roll-ups and buyouts and other kind of more traditional private equity type practices. And that leaves the smaller funds, what we like to look at as kind of the sub $100 million venture funds, as the remaining purists in the market who are still going early stage, working with founders, rolling up their sleeves, helping those founders build companies from the earliest moments in the life cycle of the company. And that's the category we think has, quite a bit of potential. That small emerging manager category really only, started to come about in the mid to late 2000s, so 2009, 2010, and now it's grown pretty significantly. Depending on who you talk to, there may be 1,500 to 1,700 of these smaller emerging manager funds. But what we've seen is the performance of those smaller funds, they have outperformed the market since 2008 and actually going back to the year 2000. And so, these smaller funds are harder to find, harder to analyze, harder to vet because,
Hmm.
they're not so large. They're not hanging a big shingle out there.
Hmm.
But from a purely investment performance perspective, they have outperformed the market. So we lean into that. We've built out a community of these small emerging manager
Hmm.
funds. We do a lot of events. We bring them together. We help them connect with potential LPs or investors who may invest in
Hmm.
their fund. And we've also built out a kind of data engine to track who these managers are and who their underlying portfolio companies are so that we can get a bit of early radar on who are those fastest growing companies coming out of those
Right.
portfolios.
And then, Michael, based on the observation, what you've seen, why do you think some of these smaller funds, emerging funds, sub 100 million, have been outperforming the market since the mid 2000s, as you stated?
Yeah, so there's a few reasons that people speak to as to why these smaller funds outperform. I mean, just at a very basic level, it's easier to 3x a $20 million fund than it is to 3x a $5 billion fund, right? There's this rule of 30, which says basically, multiply your fund size by 30, and that tells you where you need to get to, roughly have a 3x exit on the fund or a 3x return on the fund. And so, the smaller funds, just from a basic physics perspective, it's easier to, create a multiple and good returns. We like to think as well that the smaller emerging manager funds are still kind of practicing that purest form of venture capital. They're helping the founders, they're getting involved, they're supporting those companies as they're going through the kind of unique phases of their life cycle. The other thing to just think about from a simple numeric perspective is smaller funds, when they invest, the valuations are lowest in those companies.
Mm.
So you
Right.
may have an emerging manager fund who invests in companies that have, a typical, call it $5 to $10 million valuation.
Hmm.
And so if that company grows and all of a sudden has a 500 million or $1 billion valuation, the markup on that company is quite significant. At the larger companies or at the larger venture capital funds that are the platform funds, and they've got a 5 billion or $7 billion fund, they need to write very large checks. They need to write $100 million check. When you're writing $100 million check, that company is probably already worth $2 or $3 billion. And so you can start to do the math and see just what kind of multiples have to exist to get similar kinds of returns. Overall, the venture capital market is evolving. It's changing, and different participants and different players in the market are kind of pursuing different models. We tend to believe that the smaller emerging manager funds represent the greatest opportunity for investors to get that kind of venture capital alpha or exceptional return.
Right. Okay. Thank you for sharing that, Michael. Another question I had was roughly one in 1,282 high school football players will play in the National Football League. Likewise, according to the Angel Capital Association, only approximately 0.05% of startups receive VC funding. So those are long odds here. How can the CEOs that are listening in, what can they do to increase their odds of receiving VC capital?
Yeah, well, it's a really good question. And, one thing to think about is when you build a startup, and I spent many years doing this over 6 different companies that I co-founded and built. When you're creating a startup, you have a choice. You can look at it and say, "Hey, we're going to build this startup, and I'm going to go raise venture capital, and that's how we're going to grow the business." Or I can bootstrap it. And people do bootstrap these companies where they don't raise any external funding. It's hard to do, really challenging. There's not a lot of companies that do that, but it is possible. Um, if it, if it comes to the point where you're saying, okay, I do need to raise venture capital, then there's a whole checklist and set of items that you have to look at to
Hmm.
really gauge whether the project you're working on or the company you're starting is appropriate for venture capital. And then there's a further kind of list of things to look at that you'll want to be able to tackle or address in order to have a high likelihood of getting venture capital. Generally speaking, at the early stage, you need to have a differentiated product that's going after solving a very big problem in a very big market. You need to have competitive differentiation that gives you some kind of edge. Maybe that's technological, maybe it's team, maybe it's strategy. But this becomes an even bigger challenge now in our kind of current reality of AI and
Right.
less expensive and readily available AI tools. Because
Mm-hmm.
if you just look at different periods of time by comparison, in the 1990s, roughly late 1990s, there was 250 or 300 companies getting seed financing every
Mm-hmm.
year from venture capitalists. Fast forward to 2008 to 2015, that number went up to, 7 to 850 companies getting seed financing. And at the time we were all like, "Oh my God, that's so many companies getting seed financing. That's crazy. It'll never work." Right?
Right.
Now, fast forward to 2025, we have all these great AI tools that allow you to build applications and do things that used to take weeks or months. And you can sit down as a non-technical person and you can build applications. And so the last figures that I saw is that there would be something like 4,000 new startups created this year. Not all of them
Mm.
getting venture financing, but
Right.
many of them competing to get that venture financing. So in a world where the tools are so easy, that they've become so sophisticated, so advanced, but they're readily available to everybody, it means you really have to be able to build traction, show forward momentum, validate your technology, your product, your business model before even asking for venture
Right.
capital. And so
Right.
I remember back in the 1990s, oftentimes, teams or founders would be saying, "Hey, look, here's what we want to build. Here's the idea. Here's a nice pitch deck, but we haven't built anything yet." Right? And those companies, some of them would get funded. That started to change a little bit in the mid 2000s, but now the expectation is you've already built the technology. It's built, and you've put it out there in market, and you can show some early traction. And those are the companies that we're seeing are most readily getting funded by venture. And of course, there are extreme examples of companies that built the product, released it, and actually scaled their business before ever taking venture funding. The most extreme example would be there's a company called Midjourney, who I think now, initially had 12 or 13 employees and got up to over 200 million in revenue. I think they're up to like 25 or 30 employees now, but they're doing over 300 million in revenue. And
Right.
they did that without taking any funding in the beginning. And so it's a pretty different, it's a pretty different playing field now, where the expectations from venture capitalists are you're going to be able to build more, go further, and show more validation before you even ask for capital.
Right. Right. And Michael, would another challenge with that be so you have this outlier that creates just this expectation that you can do the same or something similar. But on the flip side, with the generative AI that's out there, and you mentioned you don't even have to be a coder now to develop a MVP or a prototype that you can start to scale. How does your company go to a VC investor like yourself and demonstrate that you have a moat around your business, that someone else who is in a little bit smarter can use generative AI and just produce a little bit better product?
Yeah, I think this is where it gets really intensely difficult in this new environment that we're in. I think for all early stage venture capitalists, you're looking at a few key constructs in those earliest days. You're looking at team. Who's the team? What have they done in the past? You're looking at technology. What have they built? Why is it unique? Can it scale, et cetera? You're looking at the market. Is this a big market? Is this a big problem they're pursuing and has the ability to be a big opportunity? And then you're looking at that, competitive differentiation. And oftentimes the kind of equalizer for investors is they'll just look at how much traction does the company have, prior to take funding. How many customers have you already signed on, already engaged with? How many, folks do you have utilizing the application? And they just look for those proof points and validation points, and the more of those you can knock down before even taking that external venture funding, the better. But it's definitely becoming a much more intensely competitive and high expectation part of the market.
Okay. Thank you for sharing that. This is a question that was on my mind as you were talking about all this competition with the AI. You can do more, but then it creates more competitors as well. So thank you for your response. According to the National Venture Capital Association 2025 yearbook, has a wealth of information. And one of the things I picked out there I want to ask you about, Michael, was at the end of 2024, the VC sector was sitting on approximately $307 billion of dry powder. And so we know, however, with high interest rates, that money gets expensive, not deployed. Do you view this as a problem or as a opportunity for CEOs seeking VC funding, this amount of dry powder that's out there?
Yeah, well, venture, like many of these categories, goes through these different phases and different
Mhm.
periods. We, went through a kind of unique period of time where for about a 4-year period, there were not very many IPOs and not very many acquisitions in technology for, a multitude of reasons. No IPOs because the markets were pretty volatile. Inflation was an issue, just all kinds of things that kept people from going out and going public. Acquisitions were largely a kind of structural problem because big companies were basically being kept from acquiring small companies. In the world of venture capital, the lifeblood that keeps the market moving is big companies acquiring little companies and companies going public. And so, when we talk about all this dry powder that's sitting on the sidelines, that was mostly due because the engine was being blocked, right?
Gotcha.
And it was kind of artificially being blocked. Now we see that changing. There's been more IPOs in the last, 7 months than I think in the last, 24 to 36 months prior to that. We've seen some of the biggest acquisitions ever, over the last couple of quarters,
Mhm.
notably Google's acquisition of Wiz. And so that is starting to change, which means that that dry powder sitting on the sidelines, that's already changing. You're seeing funds deploying capital at a more rapid pace. You're seeing more and more companies that are filing to go public, which is a
Yeah.
good thing. We
Yes.
just saw a couple of them last week that went out. And you're starting to see more M&A activity, big companies acquiring small companies. And, the acquisition part of it is really an important concept because the kind of law of the jungle and the concept that has made venture capital work over a number of years is this notion that large incumbent technology companies will largely outsource R&D by
Mhm.
buying smaller, independent, scrappy companies that have developed unique technologies. And so it's an important part of the ecosystem that just kind of keeps the engine running. All that's changing right now. I would say we're at the beginning of what looks like is a pretty healthy cycle in venture capital. And, we expect a lot of growth and a lot of really interesting outcomes.
Fantastic. Thank you for sharing that. And going back to your fund, for the next question, something that came to mind is what are the diligence factors that MDSV Capital looks for when you're screening and vetting companies?
Yeah. So, we have a pretty specific strategy where a part of our capital is going into these small emerging manager funds who write the first checks into companies. And part of our capital is reserved for investing directly into just those companies that break out of those portfolios and are growing really fast. And so when we look at those companies, we're looking for pretty specific growth concepts that you could characterize as early growth, usually at the series A or B.
Hmm.
Typically, we're going into companies whose revenues, top line revenue is growing at a 200% or 300% a year. They're in a really big market. They don't have a high concentration of customers, meaning they've got a pretty well diversified group of customers who are buying their technology or their product. And uh, typically we're focusing in on companies that have some unique technological foothold in a
Yeah.
big market. And
Okay.
so those are some of the key characteristics that we look for in the companies we're investing in.
Okay. Thank you very much. And so when you are investing in the fund managers and then you want to focus on the outliers to co-invest there? Is that would a very lay way of understanding would be when you pop a bag of popcorn, you kind of eat the ones that pop and the kernels are left in, you kind of throw away?
Yeah, it's a good way of looking at it. I mean, one way to think about it is if you look at this universe of emerging managers, they have acted as a really effective filter for just the
Okay.
best companies in the
Right.
market. If I look at 2008 to 2024, there's only about 1,800 companies total that drove all returns in venture cap. It
Mm,
turns out that over 60% of those 1,800 companies, the very first investor in that company was one of these small sub $100 million emerging manager funds. And it's a really important concept. It just basically means that they have reliably and credibly served as a great filter for good companies. And so when we look at the market, we're saying, okay, let's lean on these emerging managers as a great filter on the market. And then let's watch their portfolios and just try to identify the fastest growing, best, strongest companies that come out of those portfolios. And then we work to put more capital into those companies. So it's almost like kind of a double filtering of all these thousands of companies out there. And it becomes an important concept because of what we mentioned earlier. There's now going to be 4,000 companies, new startups, created this
right.
year reportedly. So the notion that you're going to go around and meet with 4,000 companies or talk to 4,000 founders is just not realistic. And so having a logical and kind of analytical way to filter those companies and
Mhm.
find the best becomes pretty important.
Okay. Okay. And another question I have for you, Michael, is how did you find this niche? When you started the fund, how did you find this niche and this value proposition of focusing on the smalling managers?
Well, we personally, meaning me and my partners
Hmm.
here, personally invested as LPs into some of these small funds going back to 2009 or so.
Okay.
And so it was a bit of a phenomenon back then, these smaller funds, scrappy funds. But we personally saw just how, just how effective these small funds were. And so
Hmm.
we had already seen that ourselves in the performance of these smaller managers. And when we came together now 3 years ago or so to create MDSV, we said, "Look, let's take all these learnings that we've had as personal investors, craft it into a more formalized strategy to where other LPs and other investors can come alongside us and participate." Generally speaking, we talk about these changes in venture capital that are being driven by new technology and just the markets changing. We believe that venture capital is gonna be a more data-driven, more analytical business. For many years, going back to the 1970s, venture capital was kind of a practice of, you know, a bunch of guys sitting around a table and talking about a founder and saying, "Well, I think it's a
Right.
good idea and maybe we should invest in it." And there's nothing wrong with that, and there's
Right.
still a lot of that going on.
Hmm.
But when you have an increase in numbers and you have a lot of people who are empowered to build things, that kind of brilliant man theory of a bunch of guys around a table trying to figure out, who they can meet with and what they invest in, it starts to break down in our opinion. And so network becomes important and
Hmm.
data becomes important and being able to kind of filter and analyze
Okay.
that information to find good opportunities.
Right. And Michael, as you were starting you did starting the fund with your partners, as you know, every venture capital fund really needs a steady flow of deals or companies and a certain quality of them to be able to vet to look at so you can, hey, we're going to look for every 100 we look at, we may only invest in a handful, but you need to have a steady flow. How'd you guys solve that problem?
Well, in many ways, I mentioned this community of emerging managers, these
Right.
small fund managers out there. In many ways, we are leaning on that community as our scout network, right?
Okay.
And that scout network is meeting with hundreds of companies and, they invest, these small emerging managers invest in anywhere from, call it 10 to 15 companies a year.
Okay.
And so they're meeting with a ton of companies, they're investing in companies, they're seeing how those companies are developing and what's advancing, what's working. And so we lean on their expertise and their credibility to really find those great companies. which then brings us the opportunity to invest in just the best company.
Thank you for sharing that. And as you were building the fund and starting off with your partners, or if you want to take an example from one of the other companies, can you share just an example of a bold move or a calculated risk that you took when you're scaling the companies?
In terms of investment in companies or as
Yes.
an operator?
Yeah, yeah, either investment companies or as an operator, whichever.
Yeah.
Good.
Well, periodically, sometimes in the venture world, there's new categories of companies or new categories of technologies that get created. Something interesting that's happened over the last 3 to 4 years in Silicon Valley is there is a new category of innovation and company that's been created, which is defense tech.
Okay.
And 5 years ago, if you said defense tech in Silicon Valley, not a lot of people would get excited, and they'd probably wonder exactly what that means. You're selling to the government, that doesn't sound too good, et cetera. What we've seen happen is, really advanced technology that includes AI, robotics, materials science, things like, jet propulsion technologies, et cetera, all
Mhm.
come together, and in this kind of explosion of unique and innovative companies, there's a number of startups pursuing this objective of really transforming what's been, a $1 trillion plus industry over the last 30 years, but it's an industry that hasn't changed much. And it was really controlled by a handful of incumbents who have been doing all that work. And those incumbents, you know, are long in the tooth, not necessarily technological, and don't move as fast as, Silicon Valley or tech startup guys. And so we've seen this really fascinating transformation where Silicon Valley entrepreneurs and founders are transforming that industry. And we were fortunate early on, starting 3.5 years ago, to say, okay, we think this is a interesting new development. And we think there's going to be great companies here, and we started investing in some of those companies.
Makes
And
sense.
that somewhat early move to bank on that vertical becoming important has really paid off well. And now, I think it's pretty commonly understood that that's an industry that's being transformed, and it's mostly young, small startup companies that are coming in and doing that transformation. And so we've backed a number of those companies and continue
Okay.
to back those companies. And I think for us, it was an early bet on
Mhm.
a vertical that was kind of unknown, but it's worked out pretty well.
Yes, yes, it has. Yes, it has. And Michael, what would you say your superpowers are, and how did you discover them throughout your career?
Well, that's a good question. I'm not exactly sure what my superpowers are. I can tell you, spending 25 plus years starting and building companies,
Right,
I think the most important thing was just perseverance and sticking with it. And,
right,
when you start, regardless of who you are and how much you've done it or how long you've done it, creating a new startup, building a new technology company, everything goes wrong. Nothing goes to plan. It's like, what was it? Mike Tyson said everybody's got a strategy until they get punched in the face or something like
right.
that.
Yes.
And the reality is, it's incredibly hard to build a successful company and get to an exit.
Mhm.
I think having gone through that multiple times, the importance of just perseverance and sticking to it and putting on the blinders and just, driving hard and not giving up is probably, I'm going to guess, the most important lesson, I took from that, and conceivably one of my superpowers. I think it helps in my position now that I've been through the process that a lot of these founders have been through.
Okay.
And so there's an understanding of just how tough it is, and that things will go wrong left, right, and center. But it doesn't mean that the mission is off, or that the eventual outcome isn't going to be great. But it requires a certain level of perseverance that's kind of unique.
Okay. Thank you for sharing that. And so, what is next for you, Michael Downing, and what's next for MDSV in terms of what's the next hill to climb? What's the next challenge that you guys are pursuing?
Yeah, well, I mean, we developed this strategy over the last few years and have slowly kind of built on the strategy. And so, our objective is to show the strategy working in terms of returns and great companies and great managers and scale that business over time. And we think there's going to be a kind of, I don't know if you want to call it a renaissance, but perhaps a kind of reversion to the fundamentals in venture capital investing that more broadly recognizes the value of these smaller funds. And you can
Okay.
see some of that being written about now and people, talking about it. But I think a lot of people are understanding that these sub $100 million venture funds really do represent kind of the pure venture capital alpha, great returns, plus the secondary benefit of potentially co-investing in some of their best companies.
Okay.
And so we expect that to continue and to be even more of a factor in the market. And we're going to play our role in structuring unique ways to take advantage of that.
Okay, thank you for sharing that. And just to follow up for our audience, you'd mentioned a couple of times being able to actually co-invest in some of the outlier companies. And is that related to the fact that some of the emerging funds are just small by nature? And
Yeah,
so
you're
for those
right.
subsequent rounds of capital that the outliers need to be able to scale, they just don't have the balance sheet or just the bandwidth. Is that correct there?
It's exactly right. So, if you look at the typical small emerging manager fund, they may have a $20 million fund, they may have a $40 million fund, but the quantum of capital that they have is just enough to be able to write those first checks into companies. And, there's an important concept in venture capital that they talk about quite a bit, which is power law and the power law of returns. And, there's really two parts to power law. Number one is they talk about, it's a very small number of companies that drive all the returns. And that's certainly true. In a portfolio of 20 companies, you probably have two companies that create all the return. And those companies have such a massive return that it makes up for all the others that don't work out for whatever reason. So that is an accurate depiction of what power law is about. But there's a second part of power law that people oftentimes don't refer to. And that is once you find one of these outliers, a company that's delivering 30x, 50x, 100x multiple on where you invested, you have to continue to invest in it at every possible juncture where you have an opportunity, or you give up a lot of the return that you could get. And it's that second part that's a challenge for these small emerging manager funds. So they're using all their capital to write that first check into the company. But then when they have a company that's growing and doing great and they're getting ready to do a later stage round to series A, B, or C, they don't have any capital to do that. And so one of the mechanisms in the way that we try to tap into that pipeline is through a program we created called the Capital Extension Program, where basically our managers tell us about those companies. They let us know, hey, this company in my portfolio, I wrote the first check into it. Now they're doing a Series B that's a big $30 million, $40 million round. We'll come in and we provide the capital. We invest in the company and we actually share economics with the manager. And we create this kind of incentive flywheel with those managers so that they come to us as a resource to take advantage of those opportunities. For us, it just means that we have total visibility and kind of an early radar
Right.
around the companies that are growing the fastest. And so that has delivered some amazing opportunities for us.
Fantastic. And then it sounds like and you can tell me if I'm wrong here, Michael, but that by co-investing here and sharing the returns with the emerging managers, you're building trust that, hey, you can bring us some of you have the outliers that are really performing well. These are really going to pop, so to speak. And we will share that return with you as opposed to having more of a shark-like attitude in saying, hey, we'll just scoop them up and thank you very much. Have a great day.
Yeah, that's exactly right. I mean, from the beginning, we've tried to structure a kind of, ecosystem approach here that's
Okay.
supportive of the emerging managers, and where everybody wins. And there's a structure where everybody benefits, and that has worked well and paid off for us. And we continue to execute that strategy. Um, it also just means that this network of emerging managers really is kind of a vital and valuable resource.
It becomes just an ecosystem just in and of itself. It becomes a
Exactly.
strong community built on trust.
Exactly.
Right. Fantastic, fantastic. And last question I have for you, Michael, is there any other thing you'd like to share with our audience just in terms of CEOs that are looking to grow and scale their companies? Maybe something that I did not ask about the fund, about your
Well,
experience?
for folks who are listening who are CEOs of companies, in entrenched industries and kind of operating, obviously, I mean, now is an important time. It's kind of a unique time. We certainly see it from our perspective, investing in new companies in Silicon Valley. All this change is being driven by new AI technologies and new AI capabilities. And I'm sure everybody's, got their inbox full
Right.
of emails and newsletters talking about this, along with,
Yeah.
whatever news reports you hear and so on. So you're probably getting a full stream of all this news, but I think it can't be overstated that a lot of this core technology that's being developed is going to fundamentally change the way we do things within our
Hmm.
businesses, within our companies, how we communicate, how we operate, how we automate a lot of processes, obviously. And so it's a crucial time to, learn and get involved and experiment and really understand what the potential is, because it's really kind of a pivotal moment. Much like I would say back in 95, 96, when the internet, was coming out, and we're all like, well, what is this thing? Is it a catalog on a screen? Or, there's a lot of misunderstanding about just what this internet thing is. And likewise, there's a lot of misunderstanding, I think, about AI and what it represents. But from our viewpoint, this is just a really profound change that's happening right now.
Right.
And, it's going to change the way we do everything from a business perspective. And so it's important to start to learn and start to get exposed to these things, and even start to experiment with some of the tools to get
Right.
comfortable.
Right. Well, Michael, thank you very much for joining us today.
Absolutely. My pleasure. Thank you, John.
Yeah, thank you. And thank you for joining us today on C2 Biz Growth, Iron Sharpens Iron podcast. You can find us on YouTube, Apple Podcast, LinkedIn, Spotify, the cornerstonegroup.us website, and other locations. We invite you to listen, subscribe, and share. See you next time. Thank you.
Thank you for listening to the C2 Biz Growth Iron Sharpens Iron podcast. And check us out on social media, share, and subscribe.